Let's get some insights on the news that is shaping the broad market action. For that, I want to welcome in Kevin Mahn, President and Chief Investment Officer of Hinian and Walsh Asset Management. Kevin, it's always great to get your perspective.
Thank you, Diane.
It's great to see you,
as well.
In person. Thank you. Let's talk a little bit about this head-spinning action. It seems like similar to yesterday, we've just, been having this kind of circular fashion and of market action when we look at equity price action. In terms of what we're seeing today, the tariffs, the extent of them seem to have caught many by surprise.
Yes.
The extent and the scale in terms of all the countries. So what stands out to you about that now and the impact?
Well, they say that April showers bring May flowers. Well, hopefully this year, this April tsunami will at least bring some green shoots in May.
I love that.
And I do think there are 4 factors that could take place, if not during April, at least during the second quarter, that will allow us to recover and ultimately position ourselves for a strong second half of the year. The first, as we've seen, any positive announcement or inkling of a positive announcements around tariffs in trade allows there to be that tailwind for equities. I think we're going to see over the upcoming week at least some announcements country-specific around these tariffs, and that's a positive. 2, the Federal Reserve. I do believe the Federal Reserve's with the potential impact on economic growth from these tariffs. And if the economy slows as much as some are expecting, we could see that first rate cut from the Fed towards the end of the second quarter, perhaps in June. Third, as it relates to the tax cuts, we need those tax cuts extended. If they're not, that is a game changer, and we can't withstand the non-extension of those tax cuts right now. That could take place during the second quarter. And finally, announced increases around defense spending and continued spending around AI infrastructure. We may learn more about that during this first quarter earnings season. If those 4 things take place during the second quarter, we could have a very strong second half of the year.
Okay, so I want to get into some of those points, but before we get into that, in terms of some of the market action that we saw, I think some of the price movement upward came after this social media post by President Trump. Be cool. This is a great time to buy. It seems like it is a very headline-driven market.
It certainly is.
Okay.
It certainly is. But I think investors need to be very cautious about reacting to those headlines, whether they're negative headlines or they're positive headlines. In other words, investors shouldn't be investing in the stock market and increasing their risk tolerance when the market is going up, just as much as they shouldn't be decreasing their risk tolerance or fleeing to the sideline when the market is going down. Stay true to your risk tolerance. I saw a great stat the other day that perhaps your audience would benefit from. It showed that over the last 20 years, 7 of the 10 best trading days over the last 20 years took place within 2 weeks of the 10 worst trading days. Wow. Now, I don't know when those worst days are going to take place. We've seen a couple of really bad days over the last week. But if you're not in the markets when those markets were down, you're likely to miss the most significant returns that the market has to offer. So stay invested, build in diversification consistent with your risk tolerance, reposition accordingly, but don't try and play this guessing game of going to the sidelines and coming back in and going back out and coming back in.
It's hard. I think you make a great point. I feel like some of the posts I see in kind of the social media world, FinTwit and Threads, et cetera, it feels like people are doing things like that, and that feels very safe when you're unsafe rather, where you're kind of chasing trends and then you end up on the losing end.
That's
right. But I want to ask you this: some economists, analysts, and even we're starting to hear from the C-suite are increasing their expectation or the odds of a risk of a recession this year. How do you view those takes?
Yeah, I've contended from the very start of this year that tariffs pose more of a growth scare than they create an inflation scare, right? Because this is the way I look at it. It's very simplistic, but the American consumer has $100 to spend. Right now, they can buy 2 goods worth $50 each. If a 20% tariff is imposed on both of those goods, now they cost $60 each. So with that $100, they can only buy one of those 2 goods. And perhaps shop for a lower cost item, or what's worse, put the $40 in their pocket. If in fact they put the $40 in their pocket and don't spend it, the economy will slow, because 70% of our economic growth comes from consumer spending. So it's a self-fulfilling prophecy with respect to slowing the economy. But the Fed could step in and cut interest rates to help abet the magnitude of that economic slowdown. So it really becomes a question of how long these tariffs do stay in place and at what levels before we start gauging the overall economic impact.
So you talked earlier about 4 potential catalysts and tailwinds: the extension of the tax cuts, Fed action, right, and then continued spending on AI, defense, and overall just the trade developments, for instance, and those being potential catalysts to spark a rebound. Which of those do you see materializing first?
The positive announcements around tariffs and trade. Things are moving at a hyper speed right now. We know that there's 70 countries apparently who have reached out to the U.S. that want to negotiate tariffs. Japan is apparently on a plane to do that just now. So I think we'll hear more positive announcements on that front. We may have to wait to the end of the second quarter to get that first rate cut. We may not know until later in May or June about the extension of the tax cuts as well. But we're going to learn after we get some positive news on the trade front about AI infrastructure spend during this quarterly reporting season. And I think what we're going to hear is that companies are continuing to spend building out their AI infrastructure, and the AI revolution isn't dead just yet.
Let me ask you this question. So if we do end up in an optimistic spot in the second half of this year, right? How should investors be positioning to be best prepared for that?
Yeah, I think investors should talk to their financial advisors about what their risk tolerance is, right? What their true risk tolerance is. If all of this volatility has unnerved them, if they have a very short investment time frame, perhaps they shouldn't be investing in equities. Perhaps they should be diversifying into bonds and other more defensive areas of the market. But if they look at their longer-term financial plan, they want to be very hesitant to make a short-term investment decision that's going to have a long-term investment consequence.
Okay, all right. And that's right. I guess this is a good time to assess where people's risk tolerance lies.
Absolutely.
If they can't handle
and be honest about it.
How the roller coaster activity has been recently.
There will be more short-term bouts of volatility ahead, but if you can navigate through those periods of volatility, I do believe that there is a light at the end of the tunnel, and that light isn't an oncoming train.
All right.
Let's hope it's not.
Exactly. I know. Let's certainly hope that's not the case. Indeed. All right. That's Kevin Mahn, President and CIO, Hinian and Walsh Asset Management. Thank you for being here, Kevin.